know, I know a little
I'm
bit and a lot of it, and maybe nothing at all about SDRRAs. So,
wondering if your questions are canned or if you make them up on the spot. Welcome back, Alchemist. This is the Alchemist Nation Podcast with myself, Walter Morello, Mitch Jorsky, and Michael Shine. Today we're interviewing Matt Calhoun, who I should have asked how to pronounce your name. Matt, how do I pronounce
Got
your
it.
name before we get
Per
started?
Perfect. You did it perfectly.
Absolutely nailed it.
Good eye.
Matt comes from Equity Trust, which is one of the it's actually the largest SDIRA companies in the world. But before we get started, Mike, can you bring us in?
Sure, massive income from passive income, which I have personally done by using my Equity Trust self-directed IRA account.
And there will be no commercials through the rest of this podcast.
epic,
Mitch
epic.
Jorsky,
Well,
how do we do it?
we organize apparently our SDRAs and collect.
And the point is not to work, it's to generate income. And since Mike did brag before the podcast that he's the only one of the three of us who has an equity trust account, I do have to point out that I have moved likely more money through equity trust than most investors that I know. That number is around $2 million is what we've moved for our private money investors and private money lenders into deals that we've done over the last 9 years. So equity trust, we've known them. In fact, equity trust, Matt, was the first SDIRA company I'd ever heard of and the first SDRA company that we ever moved money into our accounts to do one of our projects because a buddy of ours just said, "Hey, I want to invest. I got this SDIRA account and I'd like to do that with your project." And he said, "Can you do that?" And I said, "Of course we can." And then I had to figure it out.
Figure it out later. Yeah. Yeah.
I figured it out later. So,
Yeah.
Matt, how did you get, before we get into what an SDIRA is and what equity trust is,
Yeah.
how did you come to the SDIRA space? Or why do you think they're so important?
Yeah. So I started like a lot of people in our industry as a financial advisor, selling stocks, bonds, mutual funds. Did that for a long time. And funny enough, my manager at the time was like, you should really read Rich Dad Poor Dad because like, it's a really good book. It kind of teaches some basics. I'm like, okay, cool. So started doing that. I'm sure everyone listening's probably read the book. Immediately it was like, oh, what is this world? Like something I never heard of. And so I went back to him, and he actually had started owning some rental property, about 10 at the time. And he's like, go buy a duplex, live in one side, rent out the other. And my wife now, but girlfriend at the time, she's like, we could do that. Let's do it. So we did it, bought our first duplex, renovated it out, worked nights, weekends, and repeated that a few times. And once you kind of got the real estate bug, it was a little tough to be like, this mutual fund's really exciting. You guys, this S&P 500 it's great, and you could make a little bit of money. 8%'s great. So just kind of lost a little bit of the passion for the day job in that sense. And the company that equity purchased that I worked for before here in Fort Myers, they had a 1031 job open, and they did SDIRAs as well. I applied for the 1031 job. They're like, we already hired it, but you have this financial background. Maybe it makes sense to try some of this SDIRA and provide that knowledge you have through IRAs and kind of combine with the real estate. So I did that a little less than 10 years ago. Got to kind of just learn the rope basically from scratch, not even realizing real estate could be in a retirement account. So I was licensed with the states, did that for years of financial advising, and didn't even realize you could put real estate in a retirement account. I mean, I heard on some other podcasts, but you kind of hear and you're like, that's kind of strange sounding, and then ignored it. And then really kind of opened my eyes to what this world really is. And so, like I said, didn't even know what was going on. So now, yeah, I spend most of my days talking to investors, figuring out deal structures, realizing how they can use those retirement funds, and then talking with sponsors about, what it looks like to raise capital or fund deals through other people's retirement funds as well.
Oh man, I've done that. I have raised
Yeah.
capital and funded
Yeah.
projects through other people's retirement funds. I'm going to stop
Yeah.
saying OPM. I'm going to start saying OPSDIRAs.
I like it. Trademark it. Yep. It's
So
good.
Matt, you actually are unique in the sense where you're a financial advisor or you were a financial advisor,
Work.
and then you
Yeah. Yeah.
came over to the dark side of real estate and you got disenfranchised with the S&P 500, which as we know is typically let's say 90% of financial advisors, that's their one play. That's their one machine, their one muscle. And it's my biggest gripe in the financial planning industry is that and annuities. I look at those two products and I think, wow, that works for a very small group of people, but everybody else, especially people who are let's call it sub a quarter million, that mark is really hard to get to $1 million or $2 million without using some sort of leveraged asset. The SDI IRA is tax free, right? It prevents taxes. Can you talk a little bit about why taxes are so detrimental to real estate investors and why we should be using tax free or tax advantage programs?
Yeah, not even just real estate. I mean, it's the biggest expense everyone pays. We don't realize it. You pay it on your income, your gas, your toothpaste, everything is taxes. The nice thing about retirement accounts in general is that while you're growing this nest egg of money in your retirement account, it's deferring all the taxes. So I made a good profit on selling that property. All the proceeds go back to that account. I don't have to pay Uncle Sam their cut or anything else. The money goes back into the retirement account. And with good structuring, there's Roth IRAs for completely tax-free or just different ways to structure your distributions that can just minimize taxes. So it's really about tax planning and just having a plan ahead of time to limit that expense. So that's really one reason it's a big tool. It's really a tax mitigation strategy. There's other benefits, and we can kind of go into those. But like the one people think about first of all is like, how do I avoid paying taxes? Because nobody likes paying taxes.
Yeah, it's I think it's the third part of real estate investing. Like when you first start, you're thinking, how do I get the money to do the deal? Then you start realizing, hold on, like even if I had the money, I don't know what a good deal looks like. And then you get to that point where you say, okay, I got money, I got a deal, and now I'm making too much money. I'm like paying taxes when I sell these things. That's a problem because at first, none of us think we're going to sell our properties, except for let's call it the flip investors. They do intentionally go out and do that. But some of us buy and hold guys, we think we're going to hold these things indefinitely and forever. How does a self-directed IRA work compared to leaving your IRA in the stock market? And can you, if you had a 401k, can you take a 401k and turn that into an SDI IRA?
Yeah, I'll kind of back up and kind of most people, the first question is, what is an SDI IRA? And I always tell people it's a really fancy marketing term that doesn't mean anything. It's just something we've come up with in the industry to make it sound special. But when IRAs were started in the 70s, when the law was written, it didn't say you had to be invested in the S&P 500. You didn't have to invest in the stock market. The groups that were selling stocks, bonds, and mutual funds said, this is a cool thing. We're going to offer IRAs. We're already selling stocks. Let's keep selling stocks to everybody. So the financial service industry just grabbed on to it and thought that's all you could do. But really, the only assets you can't hold in a retirement account, according to the law, is collectibles and life insurance. Everything else can be held in a retirement account and still get that tax beneficial treatment. So to start, like, what is
that? So what you're saying is it's a major conspiracy by the financial institutions to push everybody into the stock market. And what the SDI companies are doing is like, hey, when this tax code was written, it was actually written for everybody to use at any time. And we're just like ringing freedom's bell and bringing it back.
I mean, sort of, yeah. The groups that were selling the most IRAs were already selling stocks, mutual funds at the time, so they just kept doing that. You mentioned equity trust being the first one. We actually weirdly started the company around the same time IRAs started. Now it was a little bit predecessor, different names, but basically our founder had real estate and a retirement. I was like, well, can I do this? Had a bunch of attorneys look through and go, yeah, it looks like you can do it. So one of the first real estate IRAs was through equity trust. I think it's 52 years ago now. Yeah.
So Matt, what's the strangest thing that you've had somebody purchase with their self-directed IRA?
Flipping racehorses.
No.
Nice.
Yeah. I mean, it's not the strangest, but it's a cool story because we'd have a client who would buy racehorses. We'd get the bills for the fee every once in a while, and then he would turn around and flip them, 6 months, a year later. So it's kind of a cool one.
How much?
So
how much
my wife,
do racehorses go for?
Yeah, I don't want to throw out the wrong number because I'd probably be wrong, but it was interesting. Yeah, I remember processing when I first started and be like, that's really strange. We've only had one client do that. But
they're expensive. Racehorses are extremely expensive.
Didn't know if we were talking hundreds of thousands of dollars or millions of dollars or.
I don't think we got anything in the millions, but I do think they were a little.
You start at like 20 grand for a good quality stock.
There you go.
Equine, and then they can go up to 80, 150. Some horses are $200,000. Like a horse's value is dependent upon how many wins it gets under its belt. And Dorina used to tell me when she was getting into this equestrian world, she's like, "Oh, well, you can make money in this." And I was like, "Oh, interested. I'm fascinated by this concept." And then she explained it to me, and I was like, "So if this thing gets hurt, my investment's done."
Yeah.
And she said, "Yeah." I said, "Those little tiny thin
Hey.
stick legs are running that fast with that giant barrel of a
Insurance.
body.
I was gonna say, I
I
bet
don't
they
know
have
if this is
insurance.
my investment
Gotta
style."
be insurance.
Insurance for everything. College athletes insure
Yeah.
themselves now. Like,
Yeah. Yeah.
Okay, so
I'm sure
Matt, how does that
Dorina can
work?
now set up her self-directed IRA so she can buy a horse
I want to listen to this
tax
podcast.
free or tax deferred. Nice job.
Walter's buying a horse in his IRA.
Yeah.
Obviously, we're primarily real estate investors. Most of our community
Yeah.
are real estate investors. We all own businesses also. So this is a unique component to what I found. Most real estate investors have an operational company. Either they flip real estate, they're realtors, they're mortgage lenders. Some of them are financial planners. Not a lot of them, because most financial planners don't actually know how to make money. They haven't figured out to crack the code like you have. Some of them are attorneys, some of them are construction workers. So they have this operational company on the side here. And a lot of people don't actually, when they're self-employed, they don't actually have a 401k or fund it. Do you find that there are people who are self-employed who actually could be funding their, because I know there's rules. I know I've considered, like, I think I'm going to go into the space I don't even know now. S Corp or C Corp gives you the capacity to create a 401k. And then from a self-directed 401k, you could actually go and turn a self-directed 401k and make that. Wait, did I just say self-directed? Talk to me, Matt. You know what I'm
Yeah.
saying, but I don't even know the terms anymore.
Yeah. So depending on the business structuring, if you're just self-employed, no full-time employees, or you have a spouse, or it opens you up to solo 401ks, which is the easiest setup. It's basically an IRA on steroids, without the TPA, without a lot of the regulation that comes into it, because it's not ERISA compliant. It's basically just a 401k for one person, or one person, their spouse, or maybe some business partners. So as long as you don't have full-time employees, that's the easiest setup. No red tape, and contributions are like 10 times what they are in an IRA. You eliminate some of the UBIT tax and some complications come in. It's a really good tool for business owners. If you have no, like I said, if you know employees. If you have some employees, now we're looking at a group 401k. The nice thing about business owner is you can structure it the way you want. When you're an employee of someone else, you're kind of subject to what rules they set into place, or whatever template the employer got from their third party administrator. And when you're the business owner, you have a little bit more flexibility. You can kind of go and say, hey, I want this. I want the ability to buy real estate. I want the ability to, if you don't want to administer it, have a group like Equity administer the real estate piece. So yeah, being a business owner is a good place to be for structuring those retirement funds. Now, like I said, when there's employees involved, you have to worry about the testing and keeping the rules compliant. But if you have no full-time employees, then you're setting up the 401k really for the benefit of yourself.
I like this. I'm actually Googling it right now, and it looks like overall maximum contribution employer
70.
is 69,000 if you're under 50, 76.5 if you're 50 or older.
But it
Key
has to
point.
be 25% of your income. So if you make 50 grand, you can't still put in 70, something like that. So
Up
Gotta make
to 25% of compensation, 20 if
Yeah.
you're self-employed due to how net earnings are calculated. Ooh, good
So-
gauge, Mike.
Yeah.
So
So
we've been doing some research on it.
yeah, Mike's right. I will say if you make less than that, the trick to getting a little bit more, and because some people have a business, they work a full W-2, but then they have their business on the side and they make 50,000. Find
Yeah.
a plan that does like after tax non-deductible contributions, because then they
Oh,
kind of
nice.
waive. Yeah, so that'll actually kind of get away around that minimum. The 25, how that works is it's 25% of your take home is when you put your hat on as an employee, you can contribute to it, and then you get to put on your hat as a business owner and make the match at that point. But yeah, you could be
Nice.
capped. The plans that are a little bit more flexible allow you to then put 100% of that in, because you can make
Gotcha.
non-deductible contributions. So yeah, they really are pretty flexible plans for those business owners.
That was
I
I like it.
I have
tricks
a
of the
different.
trade
I
right
got a
there.
question. Oh, sorry, Mitch.
No, it's tricks of the trade. I have a question too, but go
Mike, you
ahead.
just talk right over him. This is Mitch.
Do it,
He's gonna-
Mike.
yeah.
No, so I would just every time I talk to people who have IRAs, self-directed, They always mention, and this is like the big debate, whether you have allowed to have checkbook control, where you set up an LLC, get a
Mhm.
bank account with a check in the. Does equity trust allow that? Is that allowable?
Yeah, so it's a little newer for equity. Before they kind of took a hands-off approach. They just want to see kind of what the case law is, but not too aware of any custodians now that don't allow it. I know for a while there were some that didn't, but yeah, we're allowed checkbook control as well. And just kind of say what that is a little bit more. It's the direct investment of the IRA is an LLC. In most cases, the LLC is owned by the IRA and managed by the IRA holder. Now, they can have a third party manager, and some groups do recommend that you have it, but we allow the client to be their own manager. They set up an LLC bank account. We send funds to that bank account, and then they can operate their investing out of this LLC. There's a lot of benefits. I mean, obviously, some maybe legal protections depending on the state, but ease of doing transactions is great. I always tell people, especially if they're flipping, checkbook control is almost a necessity because you're writing checks to contractors, you're paying bills, you have a lot of things going on. If you're constantly having to go back to the custodian, even one who were very responsive, if I have to, pay somebody that day, or I need to bid on a property at, the courthouse auction, or go online to bid on a property, it's hard to have the custodian issuing out funds constantly, even if they're a really good custodian. So yeah, checkbook control is a great tool.
And so, Mike, there was a point where Equity Trust did slow down on that, and they made it a little bit difficult. But Matt's team, the Equity did an acquisition for the company that Matt worked for before, and Matt's company that he worked for before, that branch actually does checkbook control, which is
That's
the
cool.
only reason we said, okay, we'll bring you to the summit, because that's a major
Yeah,
factor
it is.
of how our community invests. They're
Yeah.
they're investing in, when it's time to drop a drawer, an opportunity comes up, you don't want to wait 10 days for somebody
Right.
to open an email and pass it along and write a couple documents. Mitch, I rudely allowed Michael to talk over you.
What are you
Thanks
talking
for
about?
allowing.
What are you talking about? I handed off the
I don't know if
baton.
I allowed or deeply
I
encouraged, but it
handed
was
off the
not good. It was very
baton.
toxic.
I don't know.
Oh
Well,
man.
it was all so. All right, we're gonna backtrack a step to kind
Mhm.
of go two steps forward. So now, for the people out there, because like not everyone, some people have no idea what self-directed 401k is, or even the self-directed IRA. Like they have their 401k at their job and that's it. So now, can someone assume, because with self-directed IRA, like you said, you can invest in basically everything except for collectibles. If you have a solo 401k, like if you have your business, whatever, is that the same, or is there any restrictions since it's a 401k in terms of what you can invest in?
For if you have like a self-directed solo 401k, the investment options are identical. Yeah. So
Same
the
thing.
only,
All
yeah,
right, cool. All right,
Helicopter.
so because I mean, what a lot of people don't realize, and I mean, I know you know, is like if you have a day job, like and I had a W-2 back in the day, and I had a 401k, and what I tell people all the time is I'm like, if your 401k, if your employer is not like matching, there is no point of you having a 401k because all you're doing is being stuck in a limited vehicle. Like you can basically
Mm,
invest in stocks and bonds, and that's usually about it. And you're probably usually paying a little extra in fees as
right.
opposed to if so it's like if and again, this is my opinion, whether you agree or not, if you're not getting a match in your 401k from your employer, there is not much benefit to being in that 401k. You're better off in a self-directed IRA because then A, you're usually paying less fees, B, you have more control, and C, you can then also do cool things like invest in real estate.
Right.
Not financial advice. Um, thoughts on my rant?
So I got a
yeah.
question, because it's Mitch, what you just said is that a lot of people don't know what an SDIRA is. But what I've found is our community all know what an SDIRA is at a superficial level. So if you're open to it, Matt, I'd like to go a little bit deeper into things that people don't know about an SDIRA. Like what can you not invest in? And I know that there's something called an arm's length transaction rule. Like what does that look like? And is nobody going to ask the question of like, what is the worst thing that could happen
Well, I was gonna say, what's the
in
pet
an
like? Because
SDIRA? Because I want to know.
it's less about what you can't invest in and more about how you can't go about it, right? So like what's the right way to go about it? So I mean, there's people that, might have a self-directed IRA that are interested in investing in other things, but because I get this question and I'm not even an IRA person. They're like, "Oh, like what does that look like if I want to use money for my IRA?" Because a lot of people don't know like new investors. And I'm like, I know in theory, but a guy like Matt can tell you exactly how to go about it so you don't trigger anything bad happening.
That's why we're doing
Yeah.
this podcast. Redirect them back to this podcast. They can watch it. Matt can walk them through. And for everybody who doesn't know, we're going to be at the summit. Matt will be there with us and his team. Equity Trust will be present at the summit this year. The link for the summit is summit.alchemistnation.com. Go get your register your tickets now. If you want to ask questions that we're not getting to, drop them in the chat here. And if this podcast is over by the time you see this and you're like, oh man, I wish I'd asked this question, come to the summit. Matt will be there for 3 days with us. He'll be able to answer questions, not just from stage, but literally in the hallways, at the side, on breaks, during lunches. And I suspect that if you pay for lunch, Matt will eat for free with you. So comes to the summit, ask questions. Matt, what is
Yeah.
like, yeah, if you could take that down, what are those pieces?
Yeah. The easiest one is prohibited asset classes, as I call them. That's the easiest one, which is the life insurance and collectibles. Those are outlined as being not allowed in retirement accounts. Life insurance, the only thing it really is, they have their own tax benefits, so it doesn't really need to be in there. Kick it out is kind of the thought there. Collectibles is a little bit of a gray area. We always say like antiques, artwork, but then there's groups who kind of collateralize some of those, and all of a sudden now I'm not directly buying the collectible, I'm buying securitized. So yeah, we were happy when NFTs kind of like died down, because I got that question all the time. I'm like, that's weird, and we kind of like paused and kept kicking the can, and then it kind of faded out, which was kind of nice for us because kind of yeah, exactly.
Wasn't nice for us, but
Wasn't nice for us.
Yeah, sorry.
We experimented with NFTs.
Okay.
We rolled the dice, and the dice didn't come back nice.
I've
Gotta take
got
risk.
I've got a
Yeah.
picture of an ape somewhere on the in the cloud.
I too have apes in the cloud somewhere.
Somewhere.
I can't find a buyer.
So,
One day.
hold. All right, reining it back in. So, if
Sorry.
someone use their money, I know, right?
Like, I thought we made a commitment not to talk about our losses. Wins
I'm
only.
usually the one taking it off the rails. So, as far as someone that wants to put their money to work in real estate, right? Because again,
Yeah.
this is still something that I don't like. Is not small, like small minority of the overall population like realizes they can invest in real estate with their IRA. So what basically, if someone has no clue about it, what's like kind of like the easy button basics in terms of, all right, these are the things that you need to look for or do so you essentially don't jam yourself up and end up triggering a tax event.
Yeah. So
tax
that would lead
event.
that would lead into prohibited transactions. So we say prohibited asset classes, not prohibited transactions. And this is where deal structuring is key. Some of the rules are a little weird, like anything with the IRS and the government. It's kind of written in weird ways. But this is just who you can and cannot transact with. The easiest example is like I can't buy current properties that I own. So I own a property outside my retirement account. I can't buy it for myself. I can't buy it from lineal family members. So my spouse, parents, grandparents, children, grandchildren. Those are the easiest ones.
But uncles are okay.
Yeah, here's where we're getting the weird stuff
Uncles
that
in
kind
Iran.
of.
Was that like a Senate thing?
Fascinating. My son could buy a piece of real estate from his uncle.
Somebody had a rich uncle or something, whoever wrote that law. That's crazy.
It's absolutely
the only explanation. I don't know.
Absolutely fascinating. So what you just described is equity stripping. A lot of investors will go and borrow against their own properties to pull capital out. So that's a tactic to protect your assets, right? If you're getting in a lawsuit and there's all these notes against it, well, that's worthless. Not something you could do in an SDIRA. Perfect.
Correct. Yeah, I can't transact myself or those individuals. Now, the uncle and stuff, I do that at fair market value. So however you can distinguish as fair market value, yes, I could transact with my uncle as long as it's kind of seen, if we were to get audited, as it's seen as we were transacting in good faith, fair market value. I didn't sell it to him for $1.
Gotcha.
Being a big
I mean, ideally, the SDIRA custodian is looking out for you and your investments.
Yeah.
They don't want to see you get robbed or beat up when they're on the job.
It's our job. I mean, to that point, yeah, it's our job to make sure that we keep the client in the best tax and keep the tax status of the retirement account. So if we can tell, we're going to tell, hey, you can or can't do that. That's why we review documents. That's why we look at things and provide stuff sneaks through. Like there's definitely stuff we don't catch, and then all of a sudden later, we're like, oh, we couldn't have done that. We'll have to remedy in certain ways. So that's kind of the biggest one. Really, if you want the easy answer, it's you can't benefit personally from it at that time. Now, as far as the complicated answer, then now I go to buy a property. I like this property. I have 50% of the purchase price in my retirement account, 50% outside my retirement account. I can buy that tick structure with my retirement funds. So I'm not transacting myself, but I'm outlining 50% ownership with myself, 50% ownership of my retirement account. We're going to split profits 50-50 after that. So that can be done. And that can be done with those other
partner
parties.
with your own SDIRA as a partnership.
Huh.
Is there a percentage
Yes.
that's required there?
No percentage required. So we'll see people throw 3% of the deal to their retirement funds, just start building that up. So it's doable. The only downside of it is that if you're doing that with prohibited parties, you're kind of locked into that percentage structure, because now I can't change the ownership structure without transacting with myself. So we'll see people like have their parents on, and the downside, if the parents pass away, you go to inherit it, all of a sudden ownership structures are changing and different things. So there's some complications in there, but it's definitely doable, and people do it probably very common, I would say, to get deals, like just because they have some of the money. Yeah.
I actually had a flashback because I remember Equity Trust had a really nice graphic of all the different ways that you could combine, like my SDIRA could combine with Walter's SDIRA and with Mitch, but maybe Matt doesn't have one, so he puts in, so all sorts of percentages can be in there. It's
Matt,
very-
you don't have to say yes
Yeah.
to this. You do not
So
have
cool.
to, but is it possible for you to bring brochures to the summit that have graphs and
Like,
diagrams?
I want to see the thing Mike was just
infographics.
Yeah, the
talking about.
circle. I don't know if it's
Bring
still
the circle.
This was a
I love
while
If there's a
ago.
pie chart
Yeah.
or
I'll
a
search the
triangle.
archives. Yeah.
We're not in the circle yet. We're working our way in. You're not in the
See,
circle
here's
yet.
look, very selfishly, Matt, here's what I know our audience is going to do. Every single one of them is sitting on $250,000 or more that they're looking to invest this year. But then they're going to invest that, like Mike Shine, he's going to go invest that, and then he's going to say, well, I ran out of money. Now I need to go bring somebody else's money into my deal. And that might look like I need to explain to them how an SDIRA looks like. Is it possible for you to bring a brochure that we could actually, our community could actually take 2 appointments where they could show their families, well, technically it wouldn't be their families, their uncles. They could show their
Yeah, yeah.
uncles
or
or their
aunts.
friends how they could actually use the SDIRA. And honestly, they should be showing their family how this works anyway, right? Like,
Yeah.
especially, I have this deep opinion that if your parents are in their 75, 85 range right now, they should be less exposed to traditional equities and more exposed to debt. And I don't think that just being exposed to bonds is enough. I do think that if somebody's account is, let's say, down to $500,000, or like it's almost not livable to be just at a 4% yield or a 3% yield. Like they would want something like a 10%, so they can at least maybe make that $5,000, $50,000 a year. So I've been talking to people more about and say, like, just get exposure to debt, like get some, especially as you're older, you're not going to live long enough for those equities to matter. You can't eat equity, but you can enjoy cash flow, and they're in that age range where they're not going to pay a penalty for taking it out anyway. Like, do you find that people are capable of educating their families, or is it almost easier that the topic be brought up and then they get on the phone with somebody like you or somebody at Equity Trust who can kind of walk through it? Do you guys do webinars? I know you're doing this with us, a podcast, but is there a training portal, a place that people can go that you guys have set up where it's easy for somebody to learn or bring their parents through? I'm saying parents, but like it could be the neighbor
anyone.
next door, right?
Yeah, our website does a really good job of some education. It's topical, but it's general. It's like this is some things to think about, and I think that's the important conversation that does help to have everyone have some knowledge on, that they can talk to their neighbor, their friends, their uncle. And then I think the next step is it's important to talk to someone like me or someone at the company just to kind of go through specifics. Every deal is not the same. To your point, like there are some easy investments, but not everything. It's good to talk through and then kind of think of some things, that's unique to everyone's situation. So that's where it's important to talk to someone. But I think to your point, it's very important that everyone has the ability to at least kind of mention what it is, and say, hey, why should you be doing that? Like just how you explained, why maybe not be in bonds and debt. Like we've seen a lot of people doing that. And then the shift of retirement investors has shifted to the need for income. Like they're all of a sudden they're retiring, they need income. So we've seen a shift to debt. Like there's other reasons that we've seen that as well, but that's one reason as an industry, I think we've seen a big shift towards debt investments is people want income now. They were fine with growing the portfolio for a long time, and all of a sudden the portfolio needs to feed them. So makes more sense that reason too.
And I think we've seen a lot of equity growth in portfolios. I think a lot of investors are saying, I got to take some of that risk off the table. And I know your job is not to talk about investment in that capacity anymore, now that you're out of the financial planning space.
Yeah.
But I have personally seen people say, I don't think these house prices can sustain themselves. They're saying, let me take a little bit of that risk off the table by shifting it into debt, by pulling some of that out, selling some of the properties or refinancing. And SDIRAs are a very good tool for that. Now, you talked about complex structures, but I think we can go deeper because, again, like I said, our community knows a lot about the SDIRA, at least in the superficial level. All these different people are talking about it, and it's kind of a buzzword. There's a lot of stuff on YouTube, but I don't see a lot of people going into the deeper complexities of the SDIRA. For example, when a person wants to fund an SDIRA and they want to use like a leverage strategy to do that, you did talk about partnering up with your SDI in some sort of equity play as a tool. What have you seen? Is it possible to do that with a Roth IRA? Could you self-direct a Roth IRA so you have the money goes in and there is no tax gained on that capital?
That's what I have.
Yeah. So luckily the rules
it's about to go down.
They're not different between the account types. So that's the nice thing is that nothing changes between traditional or Roth as far as those rules are concerned. Really, the difference becomes on withdrawal what the taxes are on the withdrawal. That's how those changes are. But as far as the investment practices, they're the same across the board.
So if there was a technique, go ahead, Mike. Yep. I think everybody knows where I'm going.
I was looking on the website for that pie chart, and I discovered your investment district. And I know that, Walter, what's the name of the Alchemist Nation fund you're creating? The
Alchemist Growth and Income Fund. We just call it AGIF.
AGIF. I just wonder, how is it difficult to get on to this web page so that you?
I can get you in touch with the team that puts it together. They just get a couple forms filled out and they need some info, but yeah. And then
I thought.
We're
good at filling out forms. That's awesome.
Yeah, awesome. There's always a form.
Yeah.
So yeah, and then through the same website, there's some of the education material there as well. And I will look for the brochure. I'll look for the pie chart. If there's no pie chart though, I'll look for something similar at least.
Pull up banners at the summit.
Yeah.
We're okay with graphs. We like pictures.
I'll try.
If there's a person with a small pile of money that becomes a large pile of money, I'm okay with any of those.
We like those, yeah.
So we were talking beforehand that I have a designated question, but you already said Rich Dad Poor Dad, so I'm going to tell you can't say Rich Dad Poor Dad. But,
all right.
Another book that would be your favorite book to recommend to our listeners besides Rich Dad Poor Dad.
So funny enough, I actually thought that, and I crossed out Rich Poor Dad, and I already thought of another one.
Nice job.
Yeah, look at that. Oof. So One Thing by Gary Keller and Jay Papasan.
Oh, perfect.
Yeah, I've come back to that one recently. I read it a long time ago, but then even just with business, it just comes in every day. Where you're like, man, I get so distracted by other things. It's like the 80-20 principle.
Our book of the week for this Saturday morning. We have 52 books for 52 weeks, the 52 weeks of wealth, and this week is The One Thing by Gary Keller.
Bro, I can't even tell you how ironic that is.
Wow, didn't plan that in.
Matt, like I am going to the site right now to show you, like we have the 52 wealth principles. Last week, we just did Wealth Principle 46, Simplify Your Life, The Power of Going Broke by Damon John. This week is 47, The Law of Hyperfocus, The One Thing by Gary Keller. This is absolutely nuts.
All right.
That's crazy.
There we go.
Wow.
But
All
no,
right.
but no, great book. Yeah.
Great book. Great book. Yeah.
It is by far my favorite book of all the books because I
Yeah.
often say, what is the one thing such that by doing it, everything else is easier or unnecessary? Every day I ask myself that, whether I'm serving a customer, whether I'm working with a tenant, whether I'm acquiring a property or raising capital, or I'm just telling my partners and saying, like, what in this conversation can I get for them to leverage? And so, Matt, I right now run an apartment complex portfolio, a little conglomerate with over 600 units. And every single day, there is a thing I could do that's more important than the other things. And
Nice.
so I'm going to bleed into this. If there was, no, before we do that, leverage.
Yeah.
If there was a way, if there was one thing that you could do, such that by doing it, and let's say your IRA account is like a lot of us who just heard Mike Shine talk about IRAs 3 years ago, and they're like, oh my God, I should start putting that money in. And it's like $18,000 because your lithium stocks went up and lithium stocks came back down.
They went down.
And you're still sitting at $18,000 to
In theory.
$25,000 in that IRA account, Roth.
Hypothetically speaking.
Hypothetically speaking. Because you didn't buy as much Tesla as Mike did. So
Yeah.
you look back and think, I should have bought less lithium, maybe more Tesla.
Less lithium.
If there were theoretically a maximum leveraged way, and they can fringe on the capacity of what is even possible. But if you were to say there was one thing, such by doing everything that's easier or necessary to grow your Roth from, let's call it $18,000 to bigger than that, double or triple in a year, what type of investment would that look like?
Oh man. I'll go with what's, because we're not able to give the advice part, so I'll walk the line on that one a little bit. So
not
part
advice. This is a theoretical, hypothetical strategy.
Yeah. And let's be broad. So the big thing is, I think, getting funds into a Roth. So everyone, Roths are a little bit newer. Less people have money in Roths. I would, even to this day, 70% of the accounts we set up are traditional IRAs or pre-tax, meaning when those funds come out, they're going to get taxed. So finding efficient ways to get funds to Roth is important. And there's different strategies behind that. People are getting creative on ways to get valuations down, do conversions and whatnot. So I think that's the key piece, because now we're talking about keeping more money at the end once we actually do double our money, is getting funds.
And you can tell me you don't approve of any of these, and I will agree. This is not financial advice. If you want to get Matt's legit answer, be at the summit.
I'm throwing Matt a life preserver right now, because unlike you, Walter, I once was also a financial advisor. So I know, and that's one of the reasons I didn't like being one, is because restrictions on what you could even do. Like, what you got to report all your transactions. I'm like, I'm trying to trade stocks. I ain't got time for this. But anyway, I'm going to segue into a question that keeps us in the same boat but generalizes. So, you, whether it's personally or professionally, is there a quote or is there a theme that you either use yourself in life, or you think would be beneficial to others? And it doesn't even have to be technically related to IRAs and investing, but like, what's kind of a mantra or something that you believe in that you'd like to share with people?
Yeah, because you're a successful real estate investor. You and your wife, I mean, you said it right at the beginning of this podcast. You and your wife have bought real estate. It's what brought you into this.
Yeah.
So absolutely, I like that.
Yeah. The theme right now, I think, this day and age, we're all worried about optimization. I think I kind of got into that too. It's like, oh, it has to be optimized. I even just mentioned like the most efficient way of getting things into the Roth, and going back to just taking action. That's kind of the mantra right now, is like, just take action, keep going, make a step forward. Not always worrying about making the best step or have to be the exact right thing, and just keep doing it. I think that's investing, business, everything else right now for me is just keep doing something each day and progressing, whether it's the most optimized thing or not. Just keep moving forward.
Oh, I was thinking about this. I got a specific question. Can a self-directed IRA?
Hold on, before you ask that specific question, I just got to build rapport real quick, Mike. When I first started being a real estate agent and getting into this solo like entrepreneur space, this dot was not on my forehead. I used to say to everybody, never stop moving. Right. That was like my mantra early in my career. I was like, never stop moving, never stop moving. It was like what I used to say before I said I was work with the best, which is a way better mantra for me where I'm at. But never stop moving was so powerful in the sense that it got me to where I am today. Can't make a mistake if you're moving fast enough. If you pick a direction, you educate yourself, and you move fast enough. So go ahead, Mike.
And mine, since we're doing this, mine is, I say this to Brenda a lot. I say done is better than perfect. Because if we're gonna go with perfection, we're not gonna get it done. So done is better than perfect, course correct. But my question is, can a self-directed IRA get a mortgage?
Yes. So it has to be a non-recourse loan. So whether there are groups that specialize in lending to retirement accounts, and we keep a list because there are not that many of them. There's probably a dozen in the United States that have like an IRA lending program, but you can get groups that'll structure non-recourse loans to IRAs through non-recourse loan programs. And then I always tell people private debt is going to be your next best way. You'll just get it structured as a non-recourse loan to the account. But yeah, that's a great way to build wealth is
So the Roth can actually have a private lender as long as it's there's no personal guarantee or non-recourse. Okay. Wow.
Yep.
So theoretically, you could have two equity trust accounts investing in a deal, one as debt and one as equity, and that would still work.
Yeah, I mean, get into the nuts and bolts, I guess, like technicalities. So you have a Roth account. The Roth account puts the down payment on the property. We show the full property as the asset. So I bought the whole property, and then we'll show like a negative asset of the mortgage balance. And that Roth collects the rent, pays out the mortgage, and that debt gets paid down, and then like that negative asset disappears. So your net investment keeps increasing. But yeah,
that
can definitely be
stuff nobody's talking about, man. This right here
is amazing. That's amazing.
Yeah, these are those complex structures that we all have access to. People who have an equity trust account. We all have people in our network who have an SDIRA. Sometimes there's not enough in there liquid to do a full deal, but you don't want to miss out on it. So you can go into another person's deal on the debt side. You can go in on the equity side. So the question I asked earlier, leverage strategies. So yes, you skirted the concept of it is possible to change values. Right. So absolutely. So if I were to do it, I'm thinking I'm going to have to do a value add anyway. Right. My inventory structure is buy at a 20% discount, force appreciation 20%. Hopefully the market goes up over 4 years. So maybe I get a little more appreciation there, and then I raise rents. And so hopefully I get a little more forced appreciation over a 4-year period as well. That structure leaves me at a pretty heavy equity position because I came in and now this property is 70% higher than it was. That theoretically could be done in a Roth. Mike, I can catch up. I just Matt kind of brought it to me. He brought me close enough where I think I can get to the finish line. It might take me 4 years with a large enough deal, but I could get my Roth to catch up for the 20 years I didn't have a Roth. I should have had a Roth through a real estate deal using this unique structure that I use, which isn't, by the way, Matt, that's no different from any kind of value add play. I just do big enough deals where there may be a $2 million benefit on it by the time I'm done.
That just leads me to another question. How the heck did, if you know, Matt, did Mitt Romney have an IRA that had millions and millions and millions of dollars when we can only put in $7,000 a year?
Yeah, don't know the full details, but the thought is it's all Roth as well. So the real reason people got mad, there's no tax on it. It was Roth. That the Roth IRA for Mitt came in as a small subscriber into the fund, the Bain Capital Fund, and then got exposure to the full benefit of the fund, and then over time kept rolling it into more private equity investments. So basically, his retirement account came in as any other LP, just with the Roth status. So his net return, I guess, was better than anyone else in the fund. So yeah,
amazing.
Yeah. Those stories are always fun.
Because people think of the 7,000 or the 7,500, and they're like, "This is dinky. Nothing's gonna happen with this thing." And then you hear about that account. Just blew my mind.
I think Peter Thiel's PayPal. That's what was the other thing kind of got our industry on the front page for a while. And I think that was originally like a $3,000 or $7,000 investment. Like he just owned all the shares of PayPal and a Roth account, and it was a small amount originally. Yeah,
that's crazy.
I feel like my lesson here is if I'm going to do a private equity investment, do it through my IRA.
It sounds like the word you said was private equity. Yeah.
Yeah.
Wow. Okay. This is absolutely nuts.
Fascinating.
This might be the most valuable episode for me personally, for a very long time.
Yeah.
Although we did have Eric Bone on, and he
Yeah.
said you get what you manage for. This is very much in alignment with you get what you manage for. If you want a tax-free portfolio, you have to think in advance to get there, right? If you want to actually not have to pay, theoretically, you don't actually have to pay taxes, is what this conversation is. If
Exactly.
you invest properly, if you invest in the right structures,
Yeah.
you could theoretically never pay tax as long as you die and don't sell anything before you die.
Yeah, I
Am
learned
I?
something. I learned something here because the I always see the equity trust commercial on TV, and the guy says, "I would never invest in real estate outside of my Roth IRA or his self-directed IRA." And I was like, "Yeah, whatever." But now I'm coming to the dark side.
I'm coming over.
Yeah. Yeah.
It's a tool. I mean, it's a powerful tool, but I always tell people, you should be doing them both, obviously.
Yeah.
It's a tool in your investor tool belt. Most people just don't realize they have this money parked on the sidelines or in the S&P and just not doing stuff. They're like, oh yeah, I really like it, but that's just my other stuff. Like it's a tool that you can use for your investing or investing in deals that you're passionate about. So I think that's the biggest takeaway really is it's a good tool for your investing.
Yeah, I look at the SDIRA as it's got two places in a person's life cycle, right? In the beginning of your life cycle, really that Roth is like you can leverage the gas out of that early in your career and actually go into more equities, more net worth focused projects. But then as you've accumulated wealth, whether it was through real estate or whether it was through just equities or just putting money into your accounts, you're able to shift that over to true cash flow, like true cash flow investments in your later years, because the stock market just doesn't really offer super strong yields that aren't also tied to extremely high risk. You know, if a company is offering 20% dividends, one, how long will they be doing that? And then two, they don't always survive those companies. You know, they're offering those because they're doing a cap raise, right? I saw that a lot in the mortgage-backed securities because I'm a lender myself, so obviously I invest with the bigger lenders to see what they're doing and get their reporting. So Matt, if these guys don't have any other questions, I have a
I
question.
I do not have any more questions. This is so awesome, man. I appreciate it.
And so you know, Matt, this is not my final question. One, you're at the summit and people are on breaks. I will be grilling you.
Oh
And there'll
yeah,
probably be like
that's what I'm
10
saying. At
people
this
around me who
point,
are thinking the same things
Right.
I'm
like,
thinking. I'm just saying them, but
Yeah.
so at the summit, I plan on grabbing you on the side and just be like, hey, and
Yeah.
I'm going to introduce you to a lot of people too, because
Yeah.
there's some people that have been asking me questions about who's the right custodian to go through. And there's too many. And I'm not really the person who's like, hey, just talk to this one person. I'm like, here's 3 different companies, knock yourself out, pick who you want to pick. But at the summit, I don't have anybody else there. So I kind of have to be like, answer these particular questions. But before we get to the summit, we got to end this podcast. Before we do that, if you go back in time to 20-year-old Matt, you're sitting there, maybe you haven't even met your wife yet, and you're thinking, okay, what are the 3 things I could do to get to where I am today, happier, more successfully, more financially free? Or let me change this question and make this more about the person who has been sitting on their 401k for 20 years. And let's look at it from that perspective. The person who's been sitting on their 401k for 20 years, what are 3 things that they could do, 3 pieces of advice you could give them to get to a better position for themselves, better education, better structure, so that they can be maximizing the SDIRA? I know nobody should take all their money and dump it all into an SDIRA. I know it's not a hammer that you can screw things into the wall with. But what would you say are 3 pieces of advice to give somebody who's been sitting on the fence with the SDIRA space? They've heard about it a bunch of times, but they haven't pulled the trigger and they don't quite know how much to expose themselves to it or how to use it.
Yeah, I mean, one thing is it's way more flexible than, I mean, we talk about, not being in the market. You can actually hold public equities in a self-directed IRA. We all give that an option for that. So you can do that as part of a portfolio. But the big thing is just shifting to investments that kind of meet more your goals. Like you mentioned, like too much of the planning is always just it's in the S&P, you're subject to the market risk. But like in alternatives, there are investments that fit your goal for your rest of your life. Like whether it's income now or maybe a portion of it, I go to something else or my timeline lines up perfectly with it. Like alternative investments give that flexibility where if I'm investing in a stock, that stock's plan is to just keep growing or keep the company going forever. It doesn't meet the timelines of you. So like this alternative world does actually lend itself a lot to individual investors. But as far as that, they can do a piece of it. Like they don't have to jump all in. Like if you're moving your 401k over, you can move over 10% or whatever else. So like you can keep the Schwab account, you can do all that stuff. It's a lot more flexible than people believe it is. Yeah, as far as for me, 20 years, I wish I bought more properties. I think that's the answer everyone always gives: buy way more and don't sell anything, right? But as far as anyone else, yeah, it's good to start thinking about the tax strategy. Like, and I talk to people all the time. So sometimes it's a matter of like, I'm buying this property because I eventually want to be my retirement home. So these people buy stuff in retirement plans, like perfect, but that's just gonna take some planning. Like, let's find a good mitigation strategy to get that asset out of your retirement account, paying the least amount of taxes or no taxes. And then the other option is like the actual income piece. So like, it all just comes down to what's the plan and maybe having a plan B, having a backup plan always, like an exit strategy. So yeah, if you're that investor, that's kind of what I say is like have a plan and have a plan B in case things change later, whether that's like I said, personal use, income, what retirement looks like, so on.
That is phenomenal advice. And if somebody wanted to get in touch with you, Matt, before the summit, which I can't blame them. There's a lot of questions that I'd like them to have answered before we even get there in person. What's the easiest way to get in touch with you? How could somebody find you, get more answers on their basic questions about equity trust, or if they want to go all the way deep and figure out what the next steps are so that before they meet you in person, they can be lined up to take action?
Yeah, I'm going to have a landing page for you in the show notes. That's going to link directly to my calendar, my direct phone number, everything that you can do to get in touch with me. The website's on there. So if you want to look at some of the education material ahead of time, but most of my day is spent talking to individual investors and kind of going through what this looks like and what their investment plans are. So feel free to reach out ahead of time and look forward to meeting everybody at the summit as well.
Nice.
Awesome. And Matt, so everybody who is on it right now, if you want that information, drop a comment in the chats, drop a comment in the comments below, and just say, hey, what's Matt's contact information or what's the link, and I'll get it to you. Also, if you're afraid to drop comments in the chat below because you're afraid people will see what you're doing, just send me a DM. Just ask me personally or shoot me a text, and I'll get you in touch with Matt, whatever's easiest for you. This show is all about education, inspiration, maybe ideas. We don't give financial advice. We're just talking about things that we've done. We're theorizing with things that other people have done. We're telling stories because stories are more important than just facts or ideas or strategies. Here's something that actually did work, and here's something that will work for you. I know that most people can't do what I did this year, right? I acquired 550 units in a single year, going from 50 units to 550 units. That's a
Nice.
10x return. I don't expect that most people listening to this will do that, but maybe you can take one of the strategies that we talked about today, help yourself get a little bit closer to your financial freedom goal, closer to your wealth goal. And if there's anything that we can do to support you, send me a message, drop it in the chats, or come to the summit. We'll see you there live in person. Before we get out of here, Mitch, Mike, there's a couple of phrases I like to say. I like hearing you say them. Mike, take us out of here, man.
Thanks again, Matt. Massive income from passive income. And I look forward to seeing you at the summit, Matt, as well. So,
Mitch, how do we do it?
We organize our investments in tax-free vehicles so we can collect more money.
Remember, the point is not to work, it's to generate income. Cheers to your success. We have a choice. I always work with the best. We'll see you on the next one.
peace.